Vanguard spent 8 years asking their investors a very simple question. What do you think the stock market is going to do over the next 12 months? And almost every single year, the investors, they got it wrong. But here's the part that is generally fascinating. They didn't just get it wrong randomly. They got it wrong in a very specific and a very predictable pattern. And that pattern is quietly costing everyday investors thousands of dollars over time. My name is Rip. Welcome back to Rip Talks Money. Today, we're looking at exactly what that pattern is and why your brain is wired to fall into it. And most importantly, what to actually do about it. I promise you the solution, it is simpler than you think. As always, do me a favor, hit that like button. The more likes we get, the more YouTube will know this is great content. And we need to keep on pushing it. So let's get into it. Let's talk about Vanguard, or at least let's go over what Vanguard has found over those 8 years of data. The single strongest predictor of what investors expect the market to do next year, it was what the market has done over the past 12 months, right? Good year just happened. Well, investors, they predicted that there's going to be more gains ahead. Bad year just happened. The investors predicted that more pain was coming. And they were almost always wrong. Not randomly wrong, but constantly wrong in the same exact direction. Now, I want you to think about what this looks like in practice, okay? Late 2021, the S&P 500, it returned around 28%. And investor sentiment, it was sky high. Sky high. Everyone expected more of the same, right? And then what happened the next year? The market dropped about 18%. And then flipped it. By the end of 2022, after that brutal year, your investor sentiment was at near historical lows. People were running for the exits. They were afraid to invest. They were bracing for more bad news. And then 2023 arrived. And what happened? The markets took back off. A 24% rally. Investors were most bearish right before one of the best years in recent memory. Most bullish right before one of the worst. Year after year, that same pattern repeated. Now, behavioral scientists, they have a name for this. Exploration bias. We take whatever just happened and assumed it will keep happening. And when it comes to investing, that assumption, I'm going to tell you right now, it is very, very expensive. So here's the thing. This isn't irrational. It's deeply human, and understanding why, it helps you work around it. Now, your brain, think about it, right? And psychologists call it recency bias. We automatically give more weight to recent events than older ones. Now, from an evolutionary standpoint, this was survival logic. If a predator showed up at the watering hole yesterday, assuming it might show up today, could literally save your life. You're not going to go back there if he's going to be there, right? But the stock market is not a predator at a watering hole. Recent performance, it has no reliable bearing on what comes next. The mental shortcut that kept our ancestors alive, it becomes pretty much a liability when you apply it to your portfolio decisions. Just because it happened one year doesn't mean it's going to happen the next. You got to remember that. And that's investing though. Markets don't just keep going up. You got 28%. You could then see the next year down 20%. You could then get, another 10% the next year. When you look at these things, you got to do it over a long period. You look over a period of like a decade, the average return rate is 10%. It doesn't mean you're going to get 10% every year. You could see a 30%, then a 10% down, a 20% up, and 20% down. But over 10 years, we will start averaging out, and this will start pushing, into that positive mindset. So that brings us here. What is the actual cost, right? What you see on your screen right now. Morningstar. Sure, we all heard of Morningstar. They published an annual study. It's called Mind the Gap. Go look it up if you haven't heard of it. They compared two different things here. The actual return a fund earned over a period of time and the return that the typical investor in that fund actually experienced. Now, those two numbers are almost never the same. Over the 10 years, which ended in 2024, the average U.S. stock fund and ETF, it returned about 8.2% per year. But the average dollar invested in those same funds, it earned only 7% per year. So you got a 1.2% point gap every single year, caused almost entirely by investors buying and selling at the wrong time. And that gap is consistent because Morningstar has found it in every 10-year period that they have measured, going all the way back through 2020, 2021, 2022, and even 2023. It's just not a one-time blip. It is a durable behavioral pattern that shows up across market environments. Now, let me make this concrete and give you some real numbers so you can really understand this. Let's say you invested $100,000 10 years ago and you're earning the fund's, actual 8.2% annually. You would have roughly about $219,000 today. But earning the average investor 7%, because you move money around based on market predictions, you would actually only have $197,000. Now, that is a $22,000 difference, which is created entirely by behavior, not the fund. But there's a second piece of it that's even more striking. An investor who stayed fully invested in the S&P 500 from 2003 all the way to 2023, they earned roughly 9.8%. So regardless of what the market did, up, downs, left, right, it doesn't matter. They just stayed put. They earned over 9.8%. Now, missing just the 10 best days out of those 7,300 days over that 20-year stretch, you know what cut that return to about 5.6%? Think about that. Just 10 days out of 20 years, it nearly cut those returns in half. And those best days, they almost always cluster right after the worst days. Meaning the investor most likely to miss them is the one who is moving to cash during the scary moments. And you all know the saying. You buy the blood in the streets. When there's red, that's your buying. You don't run away. You buy when you see red. Warren Buffett's even said it, which moves us here. This is the part I generally love telling people. Look, the answer for most investors, most of the time, it's just to do less. Not more, just do less. The most powerful force in behavioral finance isn't some advanced strategy. It's what happens when you build a good system here and you leave it alone. Now consider this. 401k plans, we're all very familiar with them. With automatic enrollment, they got participation rates around 90%. Plans where employees have to actively opt in, they got participation rates that are close to 60%. Same employees, same benefits, same fund options. The only difference is the default. 9 out of the 10 people, they stay where they're put. 6 out of 10 opt in when they have to actively decide. Target date funds, probably the clearest example. Everyone knows these. You start a company and you don't do anything for your retirement. They put you in like a target date 2060, 2070, right? You pick one fund tied to your retirement. It automatically rebounces from aggressive to conservative as you age. Obviously, when you're younger, more aggressive. As you get older, it gets conservative. And you do nothing. right? The less you're required to decide, the less opportunity you have to act on a bad prediction. Now, dollar cost averaging, it does the same thing in a different way. I love DCA. But in order to dollar cost average, you need to stick to a plan, a schedule. You just got to do it. People don't do it. They talk about it, but they don't do it. And they'll be doing it. They'll see the market's red. They'll stop doing it because they think it's going to go lower and they're going to get a better price. Next thing you know, it shoots up. That's the thing about DCA. We don't care what the market's doing. We're just buying weekly here. DCA, I'm telling you right now, it is your best friend. And it always works out over time. Which moves us to this. Here's a practical checklist, right? For putting all of this into action. First, check if your portfolio has drifted. If you started with 70% stocks and 30% bonds and haven't touched it, a strong market run, it may have pushed stocks to 85% or more of your portfolio. More risk than you originally intended. Rebounce back to your target. But do it based on the rules that you already set, not based on market predictions. Second, turn on automatic rebouncing if your account offers it. Most brokerage platforms do. Set it on a calendar basis or even drift thresholds and let the system handle it. You're not doing this to chase performance. You're doing it to keep your risk exposure aligned with your tolerance. Third, verify what you're actually invested in. If you rolled over an old account or started a new one, check whether your money defaulted to a money market fund. This happens more often than people realize, and I've spoken to people like, what are you invested in? They don't even know. It's kind of scary. It's your money. You should know. Fourth, zoom out when you feel the urge to act. When the last 3 months of market performance are making you nervous or greedy, pull up a 50-year chart of the S&P 500. Corrections happen, and they always will. And recoveries follow. They always do. The long arc bends upward, folks. That visual is generally grounding and is backed by a century of data. And fifth, automate everything you can. We're talking your contribution, your rebouncings, even the decision about what to invest in. The more that you remove yourself from active decision making, the less chance a bad day's headlines have to derail decades of compounding. Here's the big takeaway. The market doesn't care what you think is going to happen next. 8 years of Vanguard data and decades of Morningstar's research, it all tells the same story here. The investors who win over the long run are the ones who stop trying to predict and start building systems. Build a good structure. Automate what you can. Keep your costs low. And then just get out of your own way. It's not exciting. Nobody makes a documentary about someone who set everything on autopilot and didn't touch it for 30 years. But that person, they're probably retiring in excellent shape. If this was useful, folks, hey, give it a like. It helps more people find this channel. Drop a comment and tell me, have you ever moved money around based on a gut feeling about the market? And be honest. I read all the comments. Hey, new video coming out soon. Turn on those notifications and get ready. You're going to like it. I'll see all y'all on the next one.